Hello and welcome to our latest Insider interview. Today in the studio, I have with me Glennie, who is co-fund manager of the Aberdeen UK Smaller Companies Growth Trust. Abby, thanks for coming in today.
Thanks for having me.
So Abby, to kick off, could you explain how the investment trust invests and how you narrow down the universe of UK smaller companies?
So I think one thing that's really important for us is having a distinct investment process, and that really helps to guide that focus. So with our investment process, we talk about quality, growth and momentum as the characteristics we're looking for in companies. And obviously valuation is always a consideration in all those decisions. We also use a screening tool, which we call the Matrix, which has been in-house developed. And that uses external data around those characteristics to really narrow down that universe. And that'll identify groups of stocks that the Matrix thinks are displaying quality, growth, momentum characteristics. And Amanda and I will then utilise that list of stocks to do more fundamental research, meeting with the companies. And that really helps us to narrow down that list.
And how often do you make changes to the portfolio? Is there a particular portfolio turnover level in a given year?
So we won't be led by targeting a turnover level. We think that the investment decisions need to be the right thing for the fund. If we look historically, over the long term, there were periods of very low turnover in the portfolio. But those were during periods where we had a very stable macro environment. So we had long periods of years where we had low interest rates and inflation. We had stocks where returns of stocks compounded and compounded after years. And stock specifics were the big driver of markets. I think now we have to be aware that the macro environment is very different. So we have more top-down influences into markets. There's definitely more volatility at the moment. And so I think actually where we're seeing quality, growth, momentum, where we're seeing those stock opportunities come from, is often changing as we go through economic cycles. And I think therefore at the moment, as I'm sure we'll come to talk about, we're seeing more new ideas and turnover in the short term is certainly higher than it has been over the long term.
Let's now move on to those new holdings that you've just mentioned. So you've made several changes to the fund so far this year. So which companies have you bought?
Sure. So a variety of inputs are helping us to identify new ideas, such as the Matrix. And what we're seeing is the benefit that quality, growth, momentum will evolve. And it will highlight to us where there's stock ideas that are coming through that perhaps we haven't owned before. And there have been a lot of new ideas into the portfolio of late. I would say there's been quite an international tilt actually to a number of those. So we, for instance, added a few mining exposed stocks. So Pan-African Resources is a gold miner in Africa and Australia. Atalaya copper miner from Spain. And also Capital Limited, which is like a drilling services business. We've also added Helios Towers, which is an African telco infrastructure business. We've added Ashmore, an emerging market fund manager. And we've also added in Plus 500, which is an online trading platform. We are still seeing ideas, though, which are UK based. And I think that's important to remember is there's real areas of strength in the UK. And for instance, the portfolio has a high exposure to UK infrastructure names. But a couple of other names we've added are Shawbrook, which is a UK lender. And also Greencore, a food producer stock where that business is combining with Bakkavor. And we think there's some really interesting growth levers and cost synergy levers to that story.
And to fund those new positions, is there any commonality in terms of the types of companies that have exited the portfolio?
So I think a couple that have been bid for, there's been a lot of bids in the UK. So we did have exposure to JTC and also a small position in IPF. So both of those have been bid for. I think around the rest of them, actually, there's a variance. We've exited, for instance, Gamma, which is our UK and European communication services business, where its exposure to UK SME has been a challenge. We've also exited Trustpilot, where I think we believe that at the valuation the stock's trading at, which is perceived quite high, that they really need to make a success of the US market. And perhaps AI has come a bit early to that before they've really been able to build their brand there.
I wanted to next move on to performance. So the past 5 years have been a challenging period for investing in this part of the market. Over the past 5 years, the investment trust has made a loss of around 9% in share price total return terms at the time of this recording. Could you explain why it has been such a tough backdrop for this area?
So I think there's a few aspects. I think actually smaller companies overall globally has been really tough in recent years. And that's come partly from that macroeconomic environment we talked about. But also it's come from other areas, like for instance, AI has been a big driver, and that's been a large cap theme generally on a global basis. When we look at UK, what we've seen concerns around GDP in the UK, around political uncertainty, and those are all more challenging for the sort of smaller company segment because of the more domestic revenue compared to large cap. And I think then lastly would be our investment process. So markets have favoured value investing in recent years, and that's been more difficult if you're a quality growth manager.
We've seen signs over a shorter time period, such as 1 year, that the performance gap between UK smaller companies and UK larger companies has been narrowing. Could you explain why that's happened, and could you outline the opportunities you're seeing among UK smaller companies?
Yeah, so I mean, we saw FTSE 100 actually had a great performance year last year as an asset class. And I think when we look at the characteristics of what that offered investors, actually, small cap investing offers a lot of those characteristics now. So valuation is not everything, but it is important. And, if I take FTSE 250 as a proxy for smaller companies, there's a 15% discount to large cap now. And importantly, if we look over, say, the last 30 years historic valuations, actually FTSE 100 is a slight premium to that, whereas FTSE 250 is at a big discount still to that average long-term level. So I think there is a real valuation opportunity in the asset class, but I think it needs more than that. So, what we saw if we looked at FTSE 100, say, at the start of 2025, was it offered a lot of other characteristics. It offered attractive income yields, it offered international diversification, and also, it did benefit from flows. And I think actually when we look at small cap now, the income yield actually on small cap is now a lot bigger than large cap, and that doesn't happen that often. And I think that surprises investors, because when they think about income, they look to large cap. Actually, I think small cap markets have that to offer now. We also see similar share buyback yields. So we're seeing lots of companies, probably about half of FTSE 250 now are buying back their own shares. So I think there's lots of areas of support. And interestingly, when we speak to companies as well, I believe that more companies are now seeing direct buying from overseas-based investors, which I think is really encouraging.
And what needs to happen for fund flows to pick up? It's of course widely known that this part of the market is cheaper than larger companies. Do we need to see a sustained period of strong performance for UK retail investors to return?
And I think flows are really important because, we've seen in the open-ended space, there's been constant outflows from UK smaller companies, and that has to be a drag on returns. And when we look at the investment trust space, we see quite wide discounts and therefore a lot being spent on share buybacks within that space as well. I think for retail investors, one thing to remember is what you're being paid for to wait for that sentiment to improve as well. So I think when you look at some of those income yields and some of those levels of discount, there's a real entry opportunity in terms of that being paid to wait and what's being priced in. I think in general, though, for small cap to become more attractive and to start to generate those returns, decreasing interest rate environment would be helpful. And as we sit here today, I think with the Iran situation, that's probably been pushed out a bit.
And when you're looking at the portfolio today, which couple of companies would you pick out as being in bargain basement territory?
So I think when we talk about bargain basement, we naturally think about the things which are, the perceived cheapest stocks. Now, that's not relative to perhaps their quality or their growth characteristics, which I think actually would provide, a wider list. If we think about that bargain basement wording, though, I would highlight things like some of the UK lenders, so Paragon and Shawbrook, where I think sentiment is really driving those share prices. And actually the quality of their credit lending will be more stable through cycle than many are sort of pricing in. I think when we look at things like Jet 2, it looks very cheap now, but obviously does have some headwinds given the situation. I think also things like Ashtead technology in the oil and gas services, that looks very cheap still. And actually, even within mining, for instance, when you look at some things that have done quite well, like Pan-African Resources, actually on their valuation, I think it's still a very cheap stock with a supportive dividend yield.
Abby, thanks for your time today.
Thank you.
So that's it for our latest insider interview. Hope you've enjoyed it. For more videos in the series, do hit the subscribe button and I'll hopefully see you again next time.